Ladies and gentlemen, good day and welcome to Saakshi Medtech and Panels Limited Q4 FY'24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prabal Maheshwari from HEM Securities. Thank you, and over to you, sir.
Good evening, ladies and gentlemen. On behalf of HEM Securities, I thank you all for joining the Saakshi Medtech and Panels Limited S2 and Financial Year 24 earnings conference call. Joining us on the call today are Mr. Aniket Latkar, Chairman and Managing Director, and Mrs. Mayuri Latkar, Full-time Director and CFO of the company. For the participants, here is a brief overview. The company has a diversified portfolio that includes electric control panels and cabinets, medical X-ray systems, fabrication services, and wire harness solutions. We will commence the call with the opening thoughts from the management, post which we will open the forum for a Q&A session, where the management will be glad to respond to any of your queries that you may have. I would like to add that some of the statements made or discussed on the conference call may be forward-looking in nature, which involves risks and uncertainties. The actual results may vary from these forward-looking statements. I would like to hand over the call to Mr. Aniket Latkar, sir. Over to you.
Right, Prabal, thank you so much. So, good evening, ladies and gentlemen. I am Aniket Latkar, the Chairman and Managing Director of Saakshi Medtech and Panels Limited, and I have along with me Mayuri Latkar, Full-time Director and CFO. Along with us, we also have CA Pradnya Modi and Mr. Kishore Vingre, who are consultants to Saakshi. We are here today for our H2 23-24 earnings call. Let me start with welcoming you all to the second half of the 2024 earnings call. I believe you have had the opportunity to review the earnings presentation and the financial results that were uploaded on the National Stock Exchange. I would like to briefly talk about the company and its verticals that we are operating in Saakshi today. The company was started in the year 2011 as a private limited company by Mr. Vijay Latkar, who had a long stint as an employee of GE Healthcare. We started the journey of Saakshi by manufacturing of X-ray medical equipments, which were being supplied to GE Healthcare. Over the years, Saakshi has ventured into and started operating in 3 verticals, namely medical devices, electrical control panels, and fabrication assemblies. Out of these, the electrical control panels today contributes close to around 72% of the top line, followed by the fabrication and the medical devices respectively. Within these 3 verticals, we are catering to different industries such as the renewable energy, CNG, industrial sectors such as railways, elevators, medical and aviation sector, as well as defense. Saakshi Medtech is a Pune-based company, and we operate out of 3 factories which are catering to these 3 verticals for customers that are based pan-India and also within the Europe and the US. Presently, less than 5% of our revenues are coming from exports. However, we have seen increase in share of exports as compared to the previous years. Moving on to new updates, we have been actively engaging with new customers within all the 3 verticals. Especially, we have seen interesting developments happening on the mechanical side, where we have been able to carve opportunities both in the aerospace and the defense side. We have also been actively engaging with few strategically important customers within these areas. We have been able to successfully onboard very recently a company which is one of the leading UK-based companies, which is into manufacturing of radiators, which are typically supplied for the diesel genset market. This has been a good opportunity, especially as they are mainly catering to the data center requirements, which is a new upcoming area in the Indian industry. The present company has won a big order with MTU Rolls-Royce. Presently, the requirement for this is being catered from the UK. However, we have recently started developing a prototype, and this business we foresee to start from Q2 of this financial year. In the medical sector, very recently, we have developed our own X-ray product, which is under the brand of Saakshi, which has received a type approval from AERB as well as from BIS. Also, recently, we have finally received our approval from CDSU. We are also cataloging this product on the government portal, and we have been able to successfully install 2 systems presently, one of which is at a premier government medical hospital that is based out of Pune. On the electrical panel side, we have been able to onboard 2 customers. One is a European-based textile manufacturing company, and the other is a large Indian corporate which is having presence in the renewable energy sector, where we will be supplying electrical control panels for these requirements. Here we have already completed the prototypes for both, and we will see a revenue contribution coming from Q1 and Q2 of this financial year. We have also recently signed a technology license agreement with Siemens for supplying of IEC 61439 certified cabinets, which is an important move for us. This will enable us to start supplies for panels across different project industries. Typically, our focus would be on the data center side. We see this as a major driver for our company's growth in the future. Overall, we are seeing a healthy opportunity that is available across these sectors and are looking for a continued growth, which is expected to be around 25% in the upcoming financial year. With this, I would like to hand over the call to Mayuri to provide us updates on the finance.
Good evening, everyone. Let's have a look at the financials of FY'24. We have achieved a revenue of...
Sorry to interrupt, ma'am. Your voice is very low. May I request you to come a little closer to the device?
Sure. Can you hear me now?
Yes, ma'am. Please go ahead.
So, good evening. Let's have a look at the financials of 23-24. We have achieved a revenue of rupees 122.6 crore. EBITDA stands at 19.67 crore, which translates to around 16.14%. PAT is at 11.3 crore, which is about 9.22%. If we have a look at the revenue share of all verticals, the control panels contribute to around 72.91%. Medical devices constitute 3.29%. Fabrication contributes to 22.29%. And the remaining 1.52% is taken up by the wire harness. So if we compare it to the last previous FY 22-23, all the verticals have seen an upward trend in the total revenue share. So that's all from my side, and thank you for your patience.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Tushar Raghatir from Kamayakya Wealth Management Private Limited. Please go ahead.
Good afternoon, and thank you for the opportunity. Just wanted to know what was the reason for the flat revenue. You guided for 15-20% of growth. So, your view on that?
Right, Tushar. So, yes, so typically, whatever were our expectations for last financial year, we were on track. However, there were 2 incidences which were on a macro scale, which basically impacted on the projections that we had. So first was for one of the companies that we had onboarded, which I just mentioned, in the textile manufacturing company, which is a OEM to whom we were about to supply electrical panels. So here, typically, this is a Swiss-based corporate supplying textile equipments from India. And one of the major customer base for this company is within Turkey. And typically, there was a earthquake that happened in Turkey, due to which there was a huge drop in their deliveries, which eventually got impacted based on whatever projections we had. That is where we saw our revenue share dropping. We had typically estimated close to around 15 crores of revenue coming from this one customer. And that was one of the major reasons for the revenue share not growing. The second reason that was also one of the important aspects for us for not able to reach to the projected levels was one of our customers, which is GE Renewables. Globally, they had basically there was a strategy wherein the company was divided in three verticals, which was basically the GE Healthcare, GE Aviation, and all of the energy business, which goes under the brand of Vernova. There was a listing that happened on the 2nd of April. So due to this development, there were certain orders that were expected to flow in were also basically these got delayed. And the reason for that is that the company of GE, where we have been supplying with these wind turbine panels within India, under this agreement was basically handed over to GE Aviation. And that is the reason why all the energy business that was carried out at this factory, they gave them a short time span to execute the existing orders that were in hand. And they have been given a mandate to move out to a new facility. So this activity has already started, and the new company is, as we speak, is also being constructed, which is again a facility which is close to around 20 kilometers from where we are located. So once this facility comes up and all the qualification process happens, the orders that we had in hand, which have been pushed back, we will be able to start delivering them. Again, here typically we've seen that this also led to a revenue loss, which we had.
Got it, sir. So you mean to say that all the orders which you mentioned, they are just postponed and not cancelled, right?
Sorry?
So the orders which you mentioned just now, so these orders are getting postponed, not cancelled, right? I'm not mistaken.
Yeah. These are getting pushed back. Once the new factory is up, these will be delivered at the new facility. So the orders are not cancelled. They are basically, these were delayed or deferred for the next, once the new factory comes in.
Okay, so the revenue will be visible in the FY'25, right?
Sorry?
The revenue will be visible in FY'25.
Sorry, one second. Yeah, it's been postponed. It's been deferred to the next financial year.
Okay, and the normal growth of FY'25, that still remains. So the earlier growth and this growth, that growth would be little high, right? If I'm not mistaken.
Yeah, that's right. So whatever we projected right now, we've considered that very minimum revenue flow will come from this orders, because there'll basically be some qualification time where we'll be delivering certain panels, but that would be restricted only for that. And once the qualification happens, typically in the next financial year, that is when the order flow will continue.
Got it. And then what sort of revenue are you seeing for FY'25?
So as I said, we are looking at somewhere between 20 to 25% growth on the current financial year results.
Got it, sir. And so in terms of your defense order, are you seeing that materialize in FY'25?
Yeah. So we have been able to convert few orders right now. However, the order numbers are close to around 15 lakhs of orders 7 lakhs of orders that we have already executed. And we have close to around 1.5 crores of orders in hand that need to be delivered within this coming quarter. However, these are it's more like RFQ based, so we will continue to see more RFQs coming in pipeline. Which, however, I would also like to add over here that we've been almost able to have 100% conversion rate on whatever RFQs that we had quoted for.
Okay, so the base is quite low. So how do you see the growth in this defense order going forward?
So typically, as of today, we are only working with L&T Defense, and this is mainly based on the order flow that they are receiving. So again, I don't have an exact number in terms of what we would be able to see in terms of order flow for this financial year. However, as I said, in terms of the order in hand, presently we've got close to 1.5 crores to be executed, and that too within this quarter. So if we consider that, if not more, even if we are able to execute it in terms of the same, we are seeing somewhere around 6 to 7 odd crores of order flows getting converted for the defenses financial year.
Oh, got it, sir. And sir, the fixed asset nearly got doubled. So exactly what was this for?
Sorry, what got doubled, please?
The fixed asset nearly to more or less got doubled. So yeah. Exactly what has happened?
One second.
Yeah. So here you can see, am I audible?
Yeah.
Yeah. So here you can see, as you correctly said, the fixed assets are almost got doubled. That is typically because they have increased. We have purchased land for expansion. So for the new facility which is going to come up, and hence there is the increase in the fixed assets.
Okay, because last time you mentioned that there will be no capex required. So this is the additional plan which you came up right now, right?
Right, Tushar. So last time we had mentioned that out of the 3 facilities, 2 of them are owned by Saakshi. One of them was a rented facility.
Yes.
And we had also mentioned that we were on the lookout for a new facility which will help us to basically close one of these rented facilities and also do certain consolidation. So that activity we were able to successfully identify a place which was closer to our facility, which will help us to have a better control on the systems. And that is where the investment has basically gone through. So eventually, once the new facility comes up, we will be closing down the rented facility, and in the second phase, we'll also try and consolidate our third facility into this factory. This also basically is giving us a huge potential in terms of the future growth opportunities. So typically, this is close to around 80,000 square feet facility where we've already started construction. And so overall, we are intending in the next couple of years to have a factory build-up area of close to around 130,000 square feet at this facility. And that will be helping us basically for taking care of the new developments that happen over the next couple of years.
So if I were to ask the percentage growth in the area, so what would be that percentage, the rented one and the one which you are owning?
Sorry, percentage growth in what?
In terms of area, so the rented one compared to the one which you are owning now.
Present rented area that we were having was close to around 35,000 square feet of build-up area that we had. And as I said, once this entire construction happens, however, this will be in a phased manner. We will be able to increase that to close to around 130,000 square feet. So it will be more or less 4 times the existing facility. However, as I said, this will be planned over the next 3 years.
Got it, sir. And sir, you recently mentioned about the data center opportunity.
Yeah.
So can you please elaborate on that?
Yeah. So, what we've seen is that, of course, I mean, I'll not get into the details of how the data center business is growing. You are aware that there's been a big growth in that sector. So what we typically try to evaluate whether how we could basically look into this opportunity. And when we really deep dived into this, we realized that all typical data centers have certain qualification requirements for the panels that have been supplied. And that's when I mentioned during the introduction call that that is where we saw an opportunity, and that's where we basically have signed a technology license agreement with Siemens. So what that effectively means is that all these panels that are required by the data centers typically have a very stringent requirement in terms of the certification. So the certification that is required is basically an electrical safety standard, which is IC 61439, which has been certified, or rather these companies have basically certified their cabinets as per this certification, and then there's a technology agreement that gets licensed to us. So under this, once we have the licensing in place, we'll be able to basically bid for the projects where these requirements are coming in from. So typically, that's the area of opportunity that we are looking for the data centers.
And sir, what would be the average size of tender which will be bidding on?
So Tushar, one of the RFQs, however, at that point of time, we didn't have the certification in place. So there was a RFQ which was there, floated to us. We had seen that overall the size of that particular tender order was close to around 15 crores.
Got it, sir.
Yeah.
So my last question, in the medical devices, how are you seeing the growth going forward in terms of percentage contribution?
So Tushar, presently, we have not been really seeing uptake on the medical side of it. So two reasons for that is, one of them was that we were still waiting for the certification earlier. But now that the certification is in place, we will now be able to aggressively look at basically marketing this product. And what we, as I mentioned earlier as well, so as of today, it's our marketing strategy is basically promoting this through the government's GEM portal. So that's where the strategy for the medical devices segment as of today is there in terms of marketing. However, we have not considered a major increase for this financial year on the medical side of it.
Fair enough, sir. That was helpful. I will get back in the queue. Thank you.
Thanks.
Thank you. Before we move to the next question, a reminder to the participants: to ask a question, you may press star and 1. Next question is from the line of Amitosh Kumar from Master Trust. Please go ahead.
Hello, sir. You mentioned manufacturing of radiators with a company based in the UK for diesel gensets, and you also mentioned Rolls-Royce with it. So could you please elaborate on that?
Yeah. So basically, this UK-based company is the name of the company is Beerwood, and they have been there within the radiator business for close to around. Probably the number might be wrong, but few decades now, and they have basically there's a joint venture company in India called MTU Rolls-Royce, under which they are mainly manufacturing diesel gensets so these are high requirement diesel gensets, so typically 1 megawatt and above. And these are mainly supplied to the data center business, or where there is a high power requirement. Now, Rolls-Royce used to earlier get these radiators from this UK-based company, and these were imported. Now, since Rolls-Royce has now put up a facility over here in Pune, they were typically looking to start doing certain localization, and that is where we got this opportunity. And even as I mentioned, that through Beerword, we've been able to start certain qualifications on these radiators, and we see that by the end of by somewhere around this year, we'll be able to deliver the first prototypes. And once those are done, eventually we'll see a serial production delivery through Beerword to Rolls-Royce. So that's basically the line of connect.
Okay, sir. Thank you.
Thank you. Participants, to ask a question, you may press star and 1. Next question is from the line of Chirag Jain from Yogya Capital. Please proceed.
Yeah. Hi, sir. Thanks for the opportunity. Sir, I was a bit new to your company, so I got a bit confused between the segments you mentioned. Okay. So can you please distinguish the major segments of the company?
Yeah, Chirag. So mainly as of today, in terms of revenue split, the electrical control panels is where our major revenue stream comes from. And under the electrical control panels, there are various industries where these are being supplied to. As I mentioned, renewable energies. Again, there is air compressors. Then there is diesel genset. So that's basically the area on the electrical panel side. The second vertical is our medical devices, where typically we are manufacturing radiology X-ray systems, medical X-ray systems. And the third vertical was mainly on the fabrication side. So under the fabrication, we are catering to the railways and the aviation industry and defense for the mechanical fabrication requirements. So that's how today the split is. And the radiator business that I just mentioned on the earlier question would be eventually categorized under the mechanical fabrication segment.
Okay. So the radiator stands on that part.
Yeah.
And certification of technology and data center would stand under panel part. Am I right?
That's it.
Okay. So major three segments was that. Okay. Understood. So secondly, on the top 5 customer concentration that we have. So I got 2 names from you, GE, and the second was the Beerword.
No. So Beerword is just a new development that is happening for us, Chirag. So GE, and under GE there have been various GE verticals that we are catering to, like the GE Healthcare, GE Vernova now, and GE Aviation. And then Atlas Copco also happens to be one of our bigger customers. So this gets categorized under the electrical panels segment. Then we have Wabtec Transportation, which is a US-based company which is into manufacturing of diesel locomotives. And this gets categorized under the fabrication sector for us. So that is one of the customer for us. And then we have Otis Elevators based in Bangalore. And we've got BPL Medical Systems. So that these are some of the top 5 customers for us today.
Okay. So that was helpful enough. So, sir, I was trying to understand what makes us as a company stand out to these suppliers. So what's the difference in us compared to the peers that we have?
So Chirag, basically on the medical side, of course, we've been able to, so that's been one of our starting points. So we have been able to build in our own capabilities in this particular sector, and although the numbers today are not significant enough for us, but we have been one of the earlier companies who's been partnering with most of the end customers who are in this sector, or rather, if I may put as OEMs in this sector. So that has always been one of the major points for us because of our earlier involvement and eventually the technical understanding of these products. Secondly, on the electrical control panel side, of course, we have very well backward integrated, and that is where we've been able to really showcase our capabilities in terms of lean manufacturing for these customers, where the volume requirements are there. So we've been able to successfully fulfill their requirements. And also now that we are armoring ourselves with these certifications, that is also going to be a differentiator for us going forward in the future.
Okay. So I was trying to understand what take a customer to, what efforts do we need to put on the customer to bring him on board? That was the first part of the question. And the second was, why can't just a customer leave because he gets some much more better pricing or much more better quality? So what's on that part?
Right.
Why would we stay?
Right. So, I mean, so better pricing and better quality is something that we always strive for, and that's the reason why we've been able to successfully continue to have these customers for over a decade now. So that has been something that we very actively look into. And as I said, what takes for us to add a customer is basically this is a very long cycle of customer acquisition. So typically, because most of these are MNC customers for us, there is a very stringent qualification process that happens. There are multiple rounds of audits that get conducted, not only from their Indian counterparts, but also from their headquarters. So that is one of the key takeaways over here, is that the audit requirements are very stringent. And typically, even the customers would look at suppliers who they see as long-term partners, and that is where they also invest a lot of their time and effort for this qualifications. So it's more of a strategic association that happens when we talk about catering to the OEM business. This is not more like it's not like a project business where there'll be a single tender requirement that comes in. So these are more of like annual rate contracts that are being put in place. And that's how typically our OEM business is presently being operated.
Okay. So I got it that it takes approximately 5 years around to get a customer on board.
No, not 5 years. I'm sorry. Did I mention 5 years somewhere?
No, you didn't mention the number. I guessed it.
Okay. No, so typically the qualification time with all these things would be somewhere between 6 to 8 months, is where a customer would typically put in efforts in terms both. I mean, customers as well as us will put in efforts for getting these audits successfully completed, and post that whatever certification requirements are there in terms of type testing of these products is also the effort that goes through. So like typically, if I have to quote you an example, so one of the products that we are presently doing for Adani wind turbines. So once the prototype panel gets completed, this generally goes in for a type test, which is a significant investment that happens from the customer side as well. And the type test is basically a once requirement that it needs to get the product qualified. So typically a customer would not want to go to another supplier just for a very small cost saving and then redo the entire qualification process. And plus that, we have also built in inherent capabilities on the programming side of it. So part of that is also a co-ownership. So that is also one of the reasons why we are in a position to maintain to have these customers over the period of time.
Okay, understood. So next question arises on the bid amount. Okay, so for example, a customer wants to buy 100 units of radiation, for example, X-rays. Okay, let's assume just one section to get a basic brief. So overall, from standpoint of view, if a customer wants to buy 100 rupees of supplies, so how much would we get of that share? Because I try to understand that is it an exclusive contract to us, or are there multiple players in the multiple segments? So
Right. So Chirag, in most of the businesses that we are there today, we are exclusive partners. So if there is a particular requirement for those unique models, then that requirement will 100% be coming through us. I don't have the exact number, but if I can put it across at the top of my head, close to around 80% of our revenues will be coming from the exclusive business that we cater to.
okay, that's an interesting point to be noted. Quality would be our main standpoint of view from company's point of view and the end customer point of view. So what's the process do we have in place to maintain that?
So Chirag, a lot of effort and a lot of certifications here. So, I mean, right from the basic ISO 9001, we've moved far beyond that. So we've got ISO 13485 certifications in place. We've got Aviation Safety Standard 9100D certifications in place. We have got our product CE certified. So that kind of stringent certifications is what our products have gone through.
Okay, understood. Secondly, on the R&D side, so do we do R&D on our part, or is it the customer who brings the product and we just develop it for the customer? So what's our value addition?
Right. So on the medical side, Chirag, the development is happening at our end, at Saakshi's end. On the electrical part side, I can put the split of like around 70-30, where 70% of the technology basically is coming from the customer end in terms of the hardware part of it. And software, or rather the programming on these PLCs, is where our capabilities come in. So that's where our contribution goes on the product side, on the electrical panels. On the fabrication, metal sheet, mechanical assembly side, these are typically design components that eventually fit into a larger product at the customer end. So there, typically the designs are completely produced, or rather owned by the customer, and then there we are basically building them as per their requirements.
Okay. So you seem to be operating in a very niche segment where we have higher wallet share, higher technology, higher value add. So why don't we come on from 30% EBITDA margins rather than saying around 20? So I was trying to get on that point.
I mean, again, the effort is there to really see that how we can get the products at better margins. But again, market being competitive enough and a lot of customer, given the competition that the sectors that we are catering to is there, we've seen that there's a price pressure that is there on both the customer side as well. And that's basically the point of view in terms of the margins that we are having right now. I mean, as I said, the efforts are there to maximize them.
Okay. So what's the current capacity utilization for the company would be?
So we are close to around 75% in terms of our capacity utilization. When I'm talking about adding a single, so when we are working in a general shift, there is a possibility that there could be another shift that we can add on.
Okay. So we are currently for type of underutilized.
That's right. I won't say completely underutilized. So our general shift that I'm saying, we are more or less operational fully over there. it's on, as I said, that once the kind of requirement comes in, we would assess the need for adding another shift and trying to execute that.
So what would be the trigger to bring in the other shift, start the other shift? So what would be that trigger for us be?
So basically more order flows, reaching out for more customers. That's basically the trigger where it will come from.
Okay. Also, you mentioned some defense players, defense you entering into L&T in the defense sector.
Yeah.
So who are the other players who do you compete with in that segment?
So it's been a new development for us. So it's just been a quarter since we have had our presence over there. But typically what I know of, although not of very surety, the companies like Nibe and so there's a private listed company called so I forget the name of the second company. So Nibe is on the listed side. They are one of the bigger players who are there in the defense side.
Okay. And the other segments that we operate in?
Yeah. So on the electrical side, there have been companies like Prima, SFO, NIDAC. In fact, the bigger businesses of Siemens and Schneider are also into panel building. So these would typically be the competitors.
Medical equipment?
Medical equipments, Chirag, more or less for the products that we are doing, there are companies like Allengers, Scanray, and Adonis. Yeah, these are some of the more recognized players on the medical side.
Okay, so these seem to be more on the MNC side. These seem to be more on the outer, not to be based in India, out of India companies.
No, so Allengers, Scanray are companies that are based in India.
Okay.
Yeah.
So also on the capex plan that you mentioned, so we have we have the land, we have started the construction. So what's the total size of the capex that you're looking at? So can you go throw some color on that?
One second. 12 and 3, 15. So close to around 15 crores of capex on the construction side is what we are looking at.
So we have bought this land. Okay, so we have added almost doubled it. Okay, so we have to do 15 crores of construction. We would also need some plant and machinery. So what's the overall size of the capex of the third year?
So Chirag, the 15 crores of investment will happen in a phased manner, right? So probably in this financial year, so around 7 crores. So because the construction area that we are building, as I said, the earlier thing is a much bigger area. So at the first phase, we are just constructing close to around 45,000 square feet, which will help us replace our rented facility to this one. So that, and then on the second year is when we intend to do the construction on the other part. So this will basically be happening in a phased manner. On the plant and machinery side, I think we are presently evaluating whether we need to do any investments because our existing plant and machinery should be in a position to basically cater to the requirement. However, there is some strategy that we are also trying to evaluate to bring it more in terms of some technological advancements. We are evaluating whether we should be investing in that. But that number or that decision will take us some more time to decide upon.
So approximately adds up to 45, 50 CR of capex of total in amount.
That's right.
Okay. So second, next on the segment-wise margins. So can you give some split on that?
Yeah, one second. Segment-wise.
Hello?
Yes.
So currently we have the segment-wise revenue split. We don't have the segment-wise margin. So if you want, I can just walk through the segment-wise split for
No.
FY'24.
Revenue was available in the investor presentation, ma'am. So I was trying to look on the margin side.
Okay, I will get back to you on that, right?
Okay. Fair enough. Sir, lastly, on the growth side, so what's the maximum revenue a company can earn, and what's the peak revenue margins that we target for?
Chirag, could you please repeat that? So I understood that what is the growth that we are looking at, or what is the maximum potential you said?
What is the maximum potential revenue from our current asset base? Okay. That was the first part. And the second part was on the margins. So what margins are sustainable for us?
So I believe without considering the new factory, so somewhere, because if I just talk about the plant and machinery, we say that we are somewhere around 200 crores is where we would, 200 to 220 crores is where we'll be able to execute within the existing plant and machinery. And at least till that happens, I believe we'll be able to maintain the same margins that we have been doing for the last 2 years.
Okay. Sir, lastly on the expansion side, so you mentioned that we won't be purchasing any machinery. Okay. We are just building, buying the land and building the construction, building the plant for it.
Yeah.
So, and we aren't installing any machinery. So I'm trying to understand why not pay the rent rather than installing the 45 crores and use the 45 crores in some other productive assets. So what was the thinking behind that? Get me through it. Why I'm wrong with this?
Yeah. So basically, what we are seeing is that now we are falling short of space for doing the assembly of these products. So the machinery that is there is able to produce more parts, but we are not in a position to get them assembled. And that is where the new requirement for the floor space happens. Now, why do we continue to have it on, why don't we continue to have it on rent? And why do we invest in a new facility is, as I said, that with the growth rate that we potentially see, within this financial year, the rented facility that we have, we will again fall short of space over there. And then it would eventually lead us for more area to be looked out for doing the assembly of the products. So again, I mean, that will probably add in the fourth plant, and that typically really spreads us very thin in terms of the operational and the management of various facilities. So that is one of the main reasons why we thought that we will bring this consolidated under one bigger facility. And the reason for why we've invested it over here is typically because ideally we found something that is much more closer to where we are located presently. And because again, transportation will become a significant player if we move into a location far off, because the machines are at one particular facility, and then if we have to produce the parts at one facility and then move it over to some far off facility for doing the assembly and the liquid painting or the powder coating, then that would also probably be a compromise on the product quality. And basically the management of both the units is what was our major intent of going in for this investment. And as I said, lastly, is that this is a much bigger facility which really takes care of whatever expansion plans that we have in terms of increasing our revenues for the next 4-5 years. So keeping that in mind as well, we thought that we would go in for this investment. Also, typically the area that where we are located, land has become a very priced commodity, and plus the availability of that has also been very difficult. So fortunately, because we got something that was available close by, we have decided on making this investment.
Okay, fair enough. So after we are adding 1,35,000, out of which we are only adding 40,000 around. So rest will be added once we have some orders in hand.
That's right.
Okay. We need to move machinery. So for how much time do we expect the plant closure to be?
No, Chirag. So there is no movement. Typically, it's only the construction that happens. So we are typically seeing at close to around 11 to 12 months of time for doing the entire construction and shifting all our lines, because here again, there will be certain qualifications of these lines that need to be done as per the regulatory requirement, or not the regulatory, but the customer requirements. So that will again add in a couple of months. So till that time, we will continue to operate from our rented facility, so that there is no impact on the deliveries and on the customer orders.
Okay. Lastly, on the GE transfer part from wind energy, the GE ownership change, you mentioned that we would be requiring recertification.
No, I didn't mention that we'll be requiring recertification. No, so the recertification is on the product at the customer end. So typically when there is, as I mentioned, that whenever there is a change in complete line process, so when you're moving from one factory to the other, so they basically have to go through a qualification process for that particular line to establish the continuity of the new setup. So that is where the product that the customer is building at their new factory, that will need to be recertified or requalified basically. So the certification, so there will be no external agencies involvement in this. It is basically the internal audit or the internal process is where they will require to go in for qualification of the line.
Okay, understood. Sir, that was very helpful. I will get back in the queue. Thank you, sir.
Right, Chirag. Thank you.
Thank you. Next question is from the line of Gaurav Jain from Citigroup. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question would be on the GE Aerospace business that we have. So do we see any revenue coming in H2 from this particular client, or do we expect the revenue starting from the H1 of 2025?
So Gauravji, we have already started seeing certain revenues coming in from this quarter. And so again, this is a long qualification process time. So we've been able to qualify close to around 16 part numbers that we've already qualified. And so there is a plan to get the phase 2 and phase 3 qualifications. So in total, if I'm not wrong, close to around 48 different part numbers where we will be qualifying. Yeah, so to answer your question, we've already seen revenues coming in.
Okay, and what would be the quantum of the revenue that we expect in this year?
So Gauravji, this is presently a labor or a job work kind of an activity for us. So here basically being the material being very specific and used in the aviation engines. So this is very tightly controlled from the end customer side. So we get the material issued to us, and we are doing certain manufacturing processes on this. So this is more like a job work activity for us. And in terms of revenues, we believe that somewhere close to around, if I'm not wrong, close to around $500,000 of revenue is what we will see hopefully by the end of this financial year.
Got it. And my last question would be on the chargers which were expected to be exported to Australia, right? So,
Yeah.
I mean, progress, like, do we expect anything to start within this year, or is it going to be a lost revenue for us?
Yeah, Gaurav. So unfortunately, the end customer over there, again, based in the US, there has been certain developments at their end, and they are relooking at the strategy of getting them produced over here in India. So our product was sent across and got certified, but unfortunately, due to some internal strategy, there has been put on hold. We are awaiting for certain updates, but I don't think that we will be able to do something in this financial year.
Okay, got it. Thank you.
Thanks.
Thank you. Ladies and gentlemen, due to time constraint, we will request the participants to limit their questions to one per participant. If you have any follow-up questions, please rejoin the queue. Next question is from the line of Jatinder from Relax Capital. Please go ahead.
Hello.
Yeah.
Yeah, hi, Aniket. Good evening.
Hi, Jatinder.
So I have just one question, right?
Yeah.
If you exclude numbers so how do you see this business over 3 to 5 years? So we have three big segments, but are there adjacencies where you think over a period of time you could look at, or where you're trying to build capability today, which may contribute to your revenues in 3 to 5 years? So I want your vision in terms of, how this business could look in 3 to 5 years. That will be very helpful. Thank you.
Yeah, Jatinder. So what we intend to do on the electrical panel side of it, as I mentioned, we were till today mainly working on the OEM side of the business, where there have been customers with their products where there has been a requirement on the panel side. However, we see that it has certain limitations in terms of the geography of where the customers are located, and there are multiple other reasons where we see that there was a limited growth that was available. And there was a very conscious decision to try and see how we could really change that scenario for us. And that was precisely one of the reasons why we've entered into this agreement with Siemens. So this is basically something that will be able to really help us expand our business on the panel side and not limited to any particular industry. So here again, this being a project business, we will be really being aggressively moving in data centers. We will typically also try and look at the commercial and the residential construction space, where these days most of the clients have started asking for these certified cabinets, and we'll be trying to look at that sector. We'll also try and see how we can have our presence in the renewable energy side. So basically that is where we have gone for this certification with a very clear-cut intent to go pan-India on our panel side of the business. So that's my vision for the next 3 years on panel side of the business, where we would also probably maybe look at opportunities of doing certain vertical integrations, where we could probably look at not just delivering a panel, but then we could make it more of a electrical system offering to the customers. So that's one of the strategy that we are looking at in the next 3 to 5 years for the panels business side of it.
Okay.
Similarly, on the defense side, as I said, presently we are only limited to the mechanical business. However, our core competencies have always been on the integration part of it, and that is where we see that we would eventually like to be in the space where the entry point basically at this time was available for us only on the mechanical, and that's where we saw the opportunity. But eventually we would like to be a player would be able to become a system integrator for sub-assemblies in both the defense as well as on the aerospace side.
Okay.
Yeah, so that's mainly where we are wanting to head into.
Perfect. I think that is very helpful. Thank you. Thanks a lot.
Thanks, Jatinder.
Thank you. Next question is from the line of Ankur Gulati, an individual investor. Please go ahead.
Okay, thanks. Just a quick question. I mean, we did this couple of milestones.
Mr. Ankur, your voice is not clearly audible.
Hi. Better now?
Yes, better now. Please proceed.
Okay. Listen, we just missed a couple of milestones this year. Given the guidance of 25%, is this again based on specific orders in hand or something you'll have to go and do business development for?
Ankurji, most of it is orders in hand. I don't foresee a similar kind of a situation that we saw regarding the Turkey situation and what we happened in terms of a GE split happening. So that was something that was unforeseen for us. So typically here we would be in comfortable to say that within the whatever developments that are presently happening and whatever our existing customers, we would be in a position to achieve these numbers.
Perfect. And the GE and the Turkey and the GE thing, is this on top of 25% growth, or your 25% growth includes those two aspects as well?
No. So we've not considered that as of now in our calculation or in our guidance. Yeah.
And what probability will you assign of any of these two bigger milestones getting converted in this financial year?
Sorry, what?
Any probability you would like to assign that either GE or the other Turkey business gets converted this year? Or is that on hold for now?
So GE looks unlikely because, as I said, they are putting up a new factory and there are a lot of variables that are coming in picture over here. So that looks unlikely. On the textile part of it, maybe situation, because now everything has got resolved, there might be a probability that business we might be able to see some developments over there. But again, that we are seeing at least, so we've already done a couple of months within this year. I haven't got a lot of updates, but maybe around September time is where we will get a clear-cut picture as to whether that is something that will be coming in the revenue stream for this financial year. However, both these projects are, let me assure you, are long-term strategic partnerships that we have signed on with. So once things fall in place for both of them, we will see revenues coming from them as per projections, as per earlier projections.
Perfect. Last thing, let's say if I work with 120 crores of ballpark revenue this year, 25% of that is 30 crores. The material cost typically has been 64-65%, right?
Yeah.
So the extra 30 crores, does it straight down flow to EBITDA, or employee costs or other costs will also increase?
So part of it will go on to the finance costs that we have done for putting up this new facility in terms of the debt that has been raised. Rest, I believe everything would flow into our EBITDA.
So leaving financial costs aside, 30 crores of extra revenue, and then 36% of that will straight flow, right? So roughly 9 crores of incremental EBITDA just because of this new revenue.
That's right. So whatever has been the employee cost that will be increased for whatever we've done in this year, maybe that will be a marginal uptake in this number.
Perfect. And some interest and depreciation will increase, but then everything else flows on. That's great. Okay. Thanks a lot.
Right, Ankurji. Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to Mr. Prabal Maheshwari from HEM Securities for the closing comments.
On behalf of HEM Securities Limited, I thank Aniket sir and Mayuri ma'am for giving their time and responding to all the questions in the detailed way. I would also like to thank all the participants for joining us on this call. Now, I would like to hand over the call back to the operator.
Thank you. On behalf of HEM Securities, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.